Hey folks, welcome back to the channel. This is Jason. How's it going today? Hope you guys all saw the video that I put out early this morning on how to value a stock using price to earnings ratio. We're going to be doing a bunch of educational stuff like that in the next couple of weeks as I continue to do my live streams and talk about more current issues with technology, investing, the economy, what the Fed is doing, and all that stuff. But I really wanted to set up my channel for long-term success by creating a lot of that educational stuff there that's going to get me views over the long term. Some of my best performing videos aren't getting any more views because the topics are no longer hot, and I want to kind of shift into doing things that get views all the time. So I'm going to continue doing my live streams, of course, because I really enjoy these, and we can talk about anything anything that you guys want to talk about. Today, though, what I really want to do is go through some of the EV news that's out there and talk about it from angles that maybe some other people aren't really covering at this point. And this is probably some of the big news right here is Ford gives dealers 6 weeks to decide if they want to continue selling EVs. All right. So this is a bigger decision than you may think. The dealership model when it comes to EVs is going to change almost completely. If you look at the way dealerships make money right now, a lot of it actually has to do with service. And when it comes to EVs, there's going to be a lot less in the way of service. And there's already a lot less in the way of service. And it's just going to get less and less as time goes on and these products become better and better, simpler and simpler. And what hasn't happened yet, at least in the US market, but that you're likely to see pretty soon, is a stripped down and um, ultra simple level of EV, where it's basically just an electric vehicle without all the bells and whistles and without all of the software and without all of the tips and tricks on it, and it's just something to get you from point A to point B that's perfectly adequate. Those vehicles are going to need almost nothing in the way of maintenance. So dealerships across the nation really do have a choice to make. And Ford is really going all in on EVs right now. So in what will certainly send shockwaves across the industry today, Ford dropped the bomb at its annual dealership meetings in Las Vegas this week. Inside EVs was only one of a handful of news outlets invited to get an early look at the new Model E dealership rules, which included the presentation from the CEO, Jim Farley. In short, Ford is telling its dealer network that they have to invest, evolve, improve, and offer new services if they want to be a Model E dealership and sell electric vehicles. Model E is a new division that was created when Ford split the company into three arms: Ford Blue, Oval, Ford Pro, and Ford Model E. All of Ford's fully electric vehicles will now fall under the Model E umbrella, while plug-in hybrids and regular hybrids are part of the Ford Blue Oval. Okay. The current three BEV offerings from far left are the F-150 Lightning, the Ford E-Transit, and the Ford Mustang Mach-E. Once again, I announced it kind of on the channel that I'm kind of looking for an EV at this point. Might be looking at that Ford Lightning. Like I said, I need something that can tow a boat. So Farley talked plenty about Tesla in this meeting and how the startup electric vehicle manufacturer has roughly $2,000 price advantage over Ford. And this is the reason that Ford, along with other vehicle manufacturers, is now making that they're fully committed to making that switch over. So for everyone that is sharing memes of electric vehicles being towed away by gas vehicles. If we had the ability to share memes back when when gas vehicles were getting started, we would have seen pictures of horses pulling gas vehicles that were out of gas to a gas station somewhere. That would have happened as well. It's the same thing. It's the conservative elements of society basically getting left behind at this point because they're too slow to recognize that this is a revolution that's essentially already occurred. These are the folks that missed out on 10 years of investments in Tesla. These are the folks that are going to miss out on the next 10 years of investments in the electric vehicle industry. And it's going to change a lot of things. It's going to change this dealership model. It's going to change gas stations. It's going to change travel patterns. It's going to change a lot. I mean, what's going to happen when every day I leave my home with a full charge? I mean, how often will I need to stop at a gas station? For me, because I mostly fuel up at Costco now because it's so much cheaper. I mean, it's significantly cheaper here in Southern California, but they don't have services there like where you can buy a soda or anything like that. Me as a convenience store customer or gas station customer, I've been completely taken out of the market by Costco over the last couple of years. This is only going to get worse as I switch over to being, where all of my transportation is now fueled by the sun. And that's going to happen here probably in the next year or so. What changes is this going to bring to society? These are the questions that we have to ask us right now. And how do you make money on that? Well, dealerships basically have a choice. Ford is giving its dealers until October 31st of this year, less than 2 months, to make a decision that's going to have huge implications for the future of the franchise. The company is offering its dealers 3 options: become a Model E certified elite dealership, become a Model E certified dealership, or discontinue selling Model E vehicles effective January 1st, 2024. I think basically for anyone discontinuing selling Model E vehicles on January 1st, 2024, that's going to be tough. That's going to be very, very tough. So yeah, let me see. Hey, Jason, what is the maximum level the Fed is going to raise the rate up to? 5% or more after that? There's no maximum, Anuj. There's no maximum at all. Paul Volcker, back in the early 1980s, raised the short-term rates up to 21.2% and then paused there because he didn't need to. He crushed the U.S. economy and brought us up to a 10% level of unemployment or somewhere right around there. So there's no maximum level. I would venture to say Ray Dalio recently came out with an article somewhere basically stating, the article is really long, but the gist of the article is that if short-term interest rates hit 4.5%, that's going to bring the market down by 20%. I don't generally like to agree with Ray Dalio on a lot of things because he is a perma bear. The world is always about to collapse in his mind. Markets are always about to collapse in his mind. And honestly, if you followed his investment advice rather than looked at his the actual assets he has under management, you probably would have lost a lot of money over the long term because he's always predicting that the world is coming to an end. But this prediction in particular is really just a mathematical projection. If the 10-year, if 10-year government securities reach a level of about 4.5%, you're probably going to see a lot of money leave the stock market and go into the bond market at that point. And it just makes sense. I mean, I think the Fed wants to normalize the fixed income market to a degree. It has not been normal since 2008. Especially when it comes to the extreme short-term government securities market, that has not been anywhere near normal since 2008, since the government decided to backstop commercial paper. That is, and they only did that temporarily. And that's a really long and boring conversation that I would have with other fixed income nerds like myself, but probably not on a live stream because everyone would fall asleep. But back in 2008, the government decided to backstop what's essentially overnight loans or really short-term loans called commercial paper, which is not something that the government had ever considered backstopping before. And that sort of led to the infection in other parts of the market, and also that Fannie Mae and Freddie Mac went from being implicitly backed by the government to explicitly backed by the government when they bailed them out. The MBNA, the Municipal Bond Insurance Corporation, basically became explicitly backed by the government as well. That removed significant perceived risk from fixed income markets, and it caused a drop in yields that's been around now for a very, very long time, which is one of the things that I think has one of the backdoor causes of inflation that a lot of people don't think of is that the government actually removed risk out of fixed income investing. And that has probably encouraged people to take greater and greater risk in search of yield. And one of the things that's contributed to inflation over the years, not a primary cause, but definitely one of the things that has contributed to inflation over the years. Long argument. There's a lot in the previous couple statements that I made that people might disagree with. So yeah. Sheila's Joe says, hey, Jason from across the pond. Sheila's Joe, I said something, Sheila's Joe, about not being overly concerned with the death of the Queen, and somebody wrote me a nasty email and said they were unsubscribing. That wasn't you, but I, as an American, I do find it odd that so many Americans are attached to royalty. That's I think that's really weird. But I'm not British, but anyway, condolences. Okay, so back to this option thing here with Ford. Basically, they give them 2 months to decide whether or not they want to sell electric vehicles. I think that this is just further evidence that the battle has been won, essentially, when it comes to EVs. And if you're resisting it, you're already on the losing side. So, okay. I got a political question here. And I've been told that I need to start talking. I'm not going to become a political channel that's mixed with finance, like a person that I know on YouTube is. I'm not going to be that, but I am going to adjust this here. How do you feel about granting asylum seekers and illegals working permits, a trend they would give cheap labor for a year or so for the cost of American citizenship, and they must pass an English exam? So I'm not sure how I feel about that, actually. And to be honest, though, I don't know about passing an English exam either. I don't know if you're aware of this or not, but the United States doesn't actually have, by law, an official language. And about 30% of Americans don't actually speak English at home. Now, I happen to speak proficient English, but I also happen to speak 2 other languages as well. So I always find it weird that it's only like American citizens who are born here that only want to speak one language or insist that everyone speaks English. I think that's really strange. But in terms of granting asylum seekers and illegals working permits, asylum seekers and illegals are 2 very different things. And you can't get around the fact that people who came here illegally, they came here illegally, and it puts people who came here legally, who did the right thing. It's kind of a disincentive to come here and do the right thing. But then again, I also think that the only way to end illegal immigration is not by building a stupid, stupid wall. It's the dumbest idea ever. I live like 8 miles from it. It's already coming apart. The government spent $1 billion maintaining that stupid wall over the last decade. They spent a couple $100 million putting a new one in, and it's already falling apart. And it's already got some cheap extensions welded onto it, and there's holes in it the size of a semi truck because a plasma cutter costs a couple $100, and the cartels or just regular people can afford a plasma cutter to cut a hole in the fence and run through. They can do it. The way to stop this is to, number one, provide a path for citizenship here in the U.S. to get these people fully integrated into the economy, paying taxes, contributing to to society, or to not give them incentive to come here, meaning that there are no jobs. So we have a choice. We can either have a pathway to legal immigration, or we can start prosecuting people for hiring illegals. And actually, that is, prosecuting people for hiring illegals is probably the best way to do that. Never going to happen. Never going to happen because of who would be targeted. The people that would be targeted are the most politically powerful people in the United States. So, of course, that's not going to happen. So, I don't know what the answer is. And the fact that I live 8 miles from the border and cross regularly, I don't see a border crisis like it is being manufactured in the media. I really don't. Even when they were talking about the masses of refugees that were coming over the border in Tijuana a few months ago, I regularly passed back and forth through the border. And yes, there were more refugees there than normal, but it was not a crisis. People were being housed, they were being fed, and they were being processed. I will say one thing that's pretty odd. When I go to Tijuana now, I can speak French there anytime I want, because there are so many Haitians that live there now. And that's one of the things that I found really surprising. The last couple of times I've been over there, I've spoken just as much French as I have Spanish, which I need to work on my Spanish more than my French. So anyway, really off topic there. So how do you feel about, which will in turn raise the working participation rate, unemployment rate? So much is being made in certain political circles about the worker participation rate. But if you notice, statisticians and economists really aren't jumping out of the woodwork to talk about the working participation rate. A lot of that has to do with the fact that it's really just a feature of demographics. Participation rate in the economy has been declining since the early 2000s. And that has to do simply with an aging population. We have more people that are aging out of the workforce and not as many people that are replacing them. Is it a concern? Yes, but is it the concern? I mean, the concern that one political group says is that because people just don't want to work anymore. Well, yeah, people over the age of 60 who can afford to retire, or over 65 who can afford to retire. Those are the folks who don't want to work anymore. Now, I do think that retirement plans were accelerated for a few people because of the pandemic, and who can't find work again now that they want to go back and they're in their 60s. I think a lot of people also, after 2 years of being forced to be home, now they're happy to retire to go out and go out and go out and travel the world or something like that. And I know when I was traveling this summer, I was seeing people that had basically never traveled in their lives before who are just like, after the pandemic, I'm gone, I'm out. And we saw the absolute chaos when it came to traveling this summer. At least I did. I had 4 canceled flights one way on my trip and 2 canceled flights on the way back. So it really sucked. That part of it did. But yeah, so worker participation rate. It all really depends on if you think that we're suffering a population crisis in this country. I don't. I don't think we're suffering a population crisis in the country, but I don't have the answers to that. Um, I do think that illegal immigration, to a degree, cuts into it makes the labor market a little bit less of a market, meaning that we are probably not paying the fair price for labor for a lot of different things, because there is this constant stream of unskilled labor that is there to undercut the wages of the people that are doing those jobs. Like I know that it's very hard for someone who wants to be a roofer here in San Diego. I think prevailing wage is probably like 20, or not prevailing wage, but the wage here just for a non-unionized shop is probably like $21, $22 an hour. And that's pretty low in comparison to other cities like this. And that has to do with us being really close to the border. And there's a constant flow of people that are skilled enough to do that job. And yeah, so let me see here. Let's see. My city just bought an electric fire truck. It costs $300K more, holds 40% lost water, and can only drive 30 minutes and has a backup diesel motor. Are Evos going to be competitive against big trucks? Eventually, yes. And well, here's the thing with that. It takes a lot of energy to move water, and that's one of the big things that people don't realize about that. But yeah, it's eventually going to be competitive against big trucks. Bram has made the comment a couple of times on my channel that a lot of what trucks move is not necessarily very heavy. It's high volume and low weight. And a lot of it isn't done in long haul situations. A lot of it is done in short haul deliveries around the city, that sort of thing. I can actually see individual cities here in the future saying, okay, class 8 trucks that are operating inside of city limits, you have to be operating under battery power. So I think that we're actually probably more likely to see a bunch of hybrid class 8 trucking going on, meaning that it's going to be, you have the ability to drive 100 miles or so on battery electric power, and then your generator kicks on and starts feeding the battery. I think that's kind of the future for class 8 trucking. I think that for vehicles that are probably going to drive less than 300 miles a day, you could see, all battery, but for long haul trucking, it's going to be a hybrid vehicle all the way. I'm convinced of that now. I've been doing more and more research, more and more math on this, and thinking about the 600 miles a day. Even when we talk about adding autonomous driving, and then how that could actually like stretch out the time that that individual truck drivers could actually be in the car. I think that it's more than likely that we're going to see something like Nikola originally envisioned, but possibly with natural gas or hydrogen fuel cell, or or biodiesel or something like that. But probably a battery electric drivetrain on there, and with a really small but high power generator. And that's probably something like we're going to see. I would look at like Hyliion's Hypertruck model, or Dana International's model. I don't know if they have theirs out available for the public yet. So, Did you read about Walmart-backed fintech Even One acquisitions led by former Goldman Sachs exec? I have not read about that. I would be happy for you to send me some links via email, and I'll take a look at that. So let me see here. Interesting. Okay, Protop Ram, a lot of political questions today. So, what type of monetary and fiscal spending policy do you think we should tighten up on or be conservative with to help lowering inflation? This is not going to be a popular answer at all. We need to reduce our military spending. We spend almost $1 trillion annually on the military. Now, I like that, and to some degree, but it just infects a lot of other. It has a lot of other systematic effects in our society as well. The fact that we spend $1 trillion a year on our military, we have an entire industry that's based around it. Yeah, thanks, man. Yeah, we have an entire industry that's based around it. When I say an entire industry, like I've worked for that industry before, so I'm guilty of being involved with that to a degree. But we need to make our military quite a bit more efficient. We probably need to spend a lot less than $1 trillion a year, and especially when it comes to managing the contractor space. A lot of money is being wasted and how do I put this? Pay attention to something called the Fat Leonard case. The Fat Leonard case was a giant bribery case involving a bunch of Navy personnel. The fact is, I've done a lot of digging on that case, and the only people being punished or going to prison in that case are the ones that don't have a ton of political connections. There are other people involved in that case that were allowed to cut deals, that were allowed to be shuffled sideways, and are basically not facing any sort of ramifications whatsoever. But I think in total that might represent about $400 million of waste in return for basically some corruption by our naval officers, right? But about $400 million in waste, in fraud, and all kinds of other things. One of the ways we could do that is by simply cutting our overall military budget to begin with. So, and I think that's, like I said, that's an unpopular answer in a lot of circles. I'm not sure how exactly we do that, but a lot of that's going to have to do with cutting personnel out of the military at some point, which has happened to a degree recently, sort of within some involuntary. And this happens every once in a while. I remember back in 2008, 2009, there was a, well, it was maybe it was a little bit later in that 2011. There was a drawdown in the military where they suddenly got really, really restrictive when it came to your PT results. And if you didn't tape out right, or you're a little bit heavy, or you didn't run fast enough, or doing pull-ups, then you were in danger of being pushed out of the military. The military goes through phases like that occasionally, and and to reduce personnel expenses. And so anyway, that's just. Thank you so much for this right here, the super chat. I don't do that for the super chats, but thank you. One of the other things that I think in terms of monetary policy, though, I think we need further tightening. I think I'm in huge favor of balance sheet runoff and reducing the Fed's balance sheet. I don't think that they need to own $9 trillion worth of debt. I think that we need to rethink the way, I think that we need to force a return to normalization of some sort. And we talked about this a couple times on the channel before. How do we fix inflation right now? A couple of different proposals have been leveled here on the table. One of them, of course, is 10% unemployment for about 12 to 18 months, 7.5% unemployment for 2 years to reduce demand, or 5% unemployment over the course of 5 years. So the U.S. political system seems to like persistent high unemployment more than they like more than they hate sharp corrections, right? But I honestly think in order to do all of the things we need to do with the Fed, which is reduce that $9 trillion balance sheet, which is reduce inflation, bring demand back under control. Yes, hold on, Anush, but we're getting there. We're talking about rate increases on new issue debt. It's not going to change anything that's already issued. It's just going to change the price of that debt in the secondary market. So, but yeah, I'll get to that. But in order to do everything the Fed needs to do, I think that there needs to be a longer period of higher interest rates and longer balance sheet and a longer period of balance sheet runoff, or even in the case of the next time we need a to reduce inflation, I think that instead of allowing balance sheet runoff, the Fed actually needs to think about selling government securities. And they would, let's be clear, they would do that right now at a significant loss. Okay. And they're not there to make a profit, though. They are there to guarantee full employment, not guarantee, but they're there to influence full employment and to control interest rates. So, but the news says if interest rates increase, will that raise the debt payment of the government and the deficit? For newly issued debt, of course, everything else is issued with a fixed interest rate. There's very little debt that's insured. I actually did the calculation once live on a live stream and showed exactly how much debt service on current debt would go up if we actually raised interest rates. Remember, if the Federal Reserve raises interest rates, that doesn't automatically raise interest rates of government debt. That's one of the things that hasn't really happened so far. It hasn't been automatic. It hasn't tracked basis point per basis point because it's also sold at auction, right? But that's the other thing. That is going to be new debt that's sold at auction. Is still going to have that fixed interest rate on there. So we kind of know exactly how much we're going to be spending ahead of time. We may have to increase that over time. But we're looking at debt in the secondary market as interest rates rise is going to decline in value. So yields are going to match the new interest rate regime, which means there's going to be further losses in bond funds. And I think that if you're in long maturity bond funds right now, you should be prepared to lose more money in those long maturity bond funds. We're coming off one of the worst years in fixed income in history. That ain't going to change anytime soon. And that's one of the things that, I find pretty amazing. This has been the worst, I got to live through one of the worst years in fixed income markets, and nobody cares other than me. $9 trillion on the balance sheet is absolutely nutty. If you had to explain inflation to a 13-year-old, what is the simplest explanation? The simplest explanation is, all right, so here's the thing. There really isn't a simple explanation, and let me tell you why. There is nothing backing our money. And I know a really smart guy, a really, really intelligent guy, and we talked about what backs the American dollar, and he keeps insisting it's the power of the American worker or it's the American economy or whatever. It's not. None of those things back the American dollar except faith, right? But trying to explain this round of inflation to a 13-year-old would be just as difficult to explain it to a 50-year-old at this point, because I have this conversation over and over and over with certain people blaming all of the pandemic era spending we did on the last during the last administration. That's what's to blame for inflation. Certain people saying it's been a loose Fed policy since 2008. That's to blame for inflation. Certain people say whatever. All of those reasons are probably wrong and are demonstrated clearly by history that almost all inflation events have to do with supply and demand being out of whack. Sometimes it's for years. Most of the time, it's actual supply shock, not demand shock. This was a combination of both. We have exploding demand and massive problems with the supply chain worldwide. Explaining to people that the administration or government or monetary policy of the United States is not responsible for worldwide inflation. Every country on the planet is experiencing double-digit inflation, or at least high single-digit inflation right now, without exception. Worldwide, we all have higher food prices. We all have higher energy prices. We all have higher commodity prices, and getting goods out of China is more expensive. We're all paying more for transportation. That has nothing to do with monetary policy and has everything to do with supply shock. It's fairly obvious when you take a look at it that almost all other criticisms of the response to inflation or the causes of inflation itself almost all of those are driven by politics at this point, and very few people are addressing the fact that we can go back in history and look at the inflation after 1946, which was caused by a massive spike in demand and no way to supply all of that demand. The massive spike in inflation in 1950, with the beginning of the Korean War, was because of the threat of rationing again. Americans were afraid of rationing again, so they started buying up everything in sight, and there was a temporary surge in demand, although supplies really didn't change at all. That was a real short but extremely sharp period of inflation. Again, at the end of 1953, we saw this giant increase in demand as all of these soldiers came home from the Korean War and started spending money again and buying houses and having babies. Again, in the late 1960s, we saw a really long, sustained boom in the economy. I think a growth rate of around 4.8%, sustained for about 5 years. We saw some really large wage inflation and huge demand increases. And at that point, our supply situation, because most of it was domestic, we simply couldn't keep up. We didn't have enough people in manufacturing to do what we needed to do. The next supply shock came with the Yom Kippur War in 1973, where after the United States supported Israel, OPEC Plus decided to sanction the United States and stop selling oil to the United States. And it caused because the price of oil is not localized, it's global. The price of oil spiked worldwide. So it wasn't simply the United States being punished. It was basically everyone being punished as the price of oil started to skyrocket. Again, we see, inflation rear its, but that period lasted from 1973 all to 1979, largely because it started to infect services. And once it infected services, that inflation essentially became permanent. And this is the big worry right now. If we see inflation long enough and persistent enough, to where it really starts to infect services, and that is happening, then I don't think that you should ever be able to expect that prices are going to come back to a pre-2020 level. That is just not happening. So America's population is decreasing, resulting in more pressure on Social Security and Medicare. There's a generational bulge right now, but America's population isn't decreasing. There's just a generational bulge in baby boomers, and I hate to say this, but in terms of Social Security, to a degree, COVID might have actually done us a little bit of a favor, and depending on the demographics of who died from it. But once the baby boomers die off, Gen X, millennials, Gen Z are smaller generations, but that there's not such a bulge in population, but population is not decreasing. It's just that once the baby boomers die off, we have a whole new set of demographic issues to deal with. So, yeah. And that will affect our manufacturing also in the wrong way. Yeah, I've been saying before, I think it would be very tough for us to reshore a lot of our manufacturing just because of how cheaply it can be done in other places. But I think one of the things the war in Ukraine is showing is the effective weaponization of the U.S. dollar, and just how effective it is, and just how ineffective alternatives to that really are. And I'm thinking that reshoring may be more possible for things on the lower end of the scale than we thought. But if we want to bring manufacturing back to the U.S. in a big way, we're going to have to commit public resources to that. And we have committed public resources to that, especially with the CHIPS Act recently, with the investments in the curiously named Inflation Reduction Act, which a lot of it goes to the EV industry, the green energy industry. And I'm not really interested in green energy because it's green, not simply because it's green. I think that's cool, but cool doesn't pay the bills. Really, what I like about it is diversification. We should never be reliant on a sole source of energy. So never rely on a sole source of energy. I want to see power coming from solar, power coming from wind, power coming from geothermal, power coming from tidal power coming from gravity storage. I want to see battery storage of power. I want to see all kinds of things out there, and I want to have a smart grid like a number of states have that are able to handle that. So and I do think though that it could affect manufacturing the wrong way, but we're looking at bringing back a lot of high-end manufacturing to the U.S. And the CHIPS Act, I think, was kind of the first step to that. Our investments in solar are kind of a first step to that, although solar is really commoditized. But yeah, Marjorie Taylor Greene introduced articles of impeachment on Joe Biden because he wants to go solar because she thinks the lights are going off at nighttime. I don't even know. I didn't think that was true until I actually read what she wants to submit. And man, I don't understand how some people get elected. I really don't. Yeah, let me see here. I'm with clean energy movement and electrification movement, but since Russia is being a jerk with oil, how will we solve the oil shortages? We do not have an oil shortage at this point. And this is one of the things that's also being politicized, and I haven't looked up the numbers in a few days, but the best place to look for these numbers is Baker Hughes rig count. All right. So the Baker Hughes rig count, I think, is at least 50 years old at this point. And you'll be able to see what's going on. And this is the best unbiased source here. So in the U.S. right now, there are 75 active oil rigs that are exploring. That's up 256 from last year, roughly 50% increase just over the last year. In Canada, there's 205. That's 62 increase over the last year, and that's roughly a 30% increase over the last year. So internationally, there's only 860 rigs that are drilling right now, actively drilling. So the United States and Canada are responsible for more than half of the oil drilling in the entire world at this point, and most of it is being done in the United States. So people that are saying that it's oil policy that is preventing us from producing more oil, that is a load of BS. We are drilling more than half. We're doing more than half of all the exploration in the entire world right now, and it is being done in the United States. For two things are going on here. There was an auction that was canceled in March of 2021. That auction went through in November of 2021, but there was a lot of political hay that was being made saying that the Biden administration was preventing drilling permits from being issued. None of that was true. What they wanted to do was a study to see how much they could raise drilling royalties by, because royalties had not been updated in years and years and years. So basically, oil companies were allowed to drill on private land. These are for-profit companies allowed to drill rather on public land without properly compensating the federal government for the oil that they were extracting from a public resource. Royalty rates needed to come up. All of those were eventually sold in, actually, it wasn't November, it was September, I think. And essentially, there were more oil leases done in the first year of the Biden administration than any other administration, I think, since the 1980s. It had been like since 1981 or 82 or something ridiculous like that. But a very, very long time. So, and I'll say one thing, though. Biden doesn't really have an energy policy at all. Trump didn't have an energy policy at all. Obama had a bad energy policy where he was the last one to really limit exploration and drilling. And Bush had a very good energy policy. But the market in all of those presidencies has been good, bad, in between, and everywhere in between, right? And a lot of it doesn't have that much to do with energy policy. But the energy policy that's out there right now, which is no energy policy, is not preventing companies from going out there. Just read this right here. The United States basically and Canada account for 964 active rigs right now that are exploring for oil. Internationally, there's only 860. So anyone telling you that we aren't exploring, we aren't drilling, is just a liar. And also, if you don't know the oil industry, you would look at another chart that shows how the rig count worldwide has been declining over the last 20 years or so. Most people pull up just the United States and show the rig count. They're like, look, we don't drill as much as we used to. No, we need a lot fewer rigs than we did 20 years ago because technology has changed pretty vastly as far as what those rigs can do, how they can drill, all kinds of things. And we don't need as many rigs as we did in the past. So, but a 50% increase in the United States in a year That's not somebody limiting exploration. So we don't have an oil shortage at this point. We did have a bit of an inventory shortage for a while until companies started to decided to produce more. And I actually, where is this? And I'm going to show you why that is exactly real quick. And I was just looking at this today. Marathon Oil quarterly report. I was actually doing a just sort of an investigation. I'm trying to find something with the right price to earnings growth ratio in order to demonstrate what I want to in the next video that I'm doing on price to earnings ratios. Let me see here, and I'm going to show you guys what I'm talking about here. Well, crap. There we go. All right. So we're looking at the. So one of the reasons is they're not companies, oil companies are not investing their money right now into exploration. They're doing two things. They are paying dividends and they're doing share buybacks. So continue to exceed the commitment to return at least 40% of adjusted CFO to equity investors, meaning they're returning more than 40% of their income essentially to equity investors, to stockholders. They returned $2.5 billion to equity investors through share repurchases and dividends since achieving the leverage objective in October 2021. Approximately 55% of adjusted CFO, approximately 70% of adjusted free cash flow over the trailing 3 quarters. All of the oil companies are doing this right now. They're not dumping tons of money into new exploration. They're doing it as they feel they can take the risk. The majority of what all of these companies are doing right now is share buybacks and raising dividends. Some of that is because they're gun shy after what happened in 2007, where they made these massive investments in shale fields, and that came back to bite them. And a lot of the companies that I used to work with back in the early 2000s and late 1990s, they are now out of business. I was or at least the near out of business, like Hercules Oil, Seadrill, all these companies are just gone because these are all offshore drilling companies that I worked with at some point. These companies are all gone because of how much they invested in capex, and then how much that was going to cost them if it was idled. Oil companies right now, they're worldwide, they're not doing that. They're spending money right here, return $2.5 billion to investors through share repurchases and dividends. Executed $2.3 billion of share repurchases since October of 2021, reducing outstanding share count by 15%. Includes over $1.6 billion of share purchases year to date. So this year alone, instead of investing in new drilling, they repurchased $1.6 billion of their own shares, and they're expecting $4.5 billion of 2022 cash flow, and they've already spent $1.6 billion of that in share repurchases, and that's assuming $100 a barrel for West Texas Intermediate and $6 in I forget what the MM is called, but that's the Henry Hub gas. But I've looked through a lot of these. This is very very good. This is very good. Hold on. Are you aware of Brent Johnson's dollar milkshake theory? That sounds really familiar. Like I probably saw that in economics school. When I took economics classes back in university at some point. I don't remember what that is though. I'd be happy for you to inform me what that is. So, in talking of inflation, do you think now Ethereum is ultrasound money with inflation's drop from 4.62 to 0.49 with its are you talking about Ethereum is now ultrasound money? Let's talk about that. Let's clarify, Joe, with what you're talking about. So, I do want to talk about Ethereum a little bit more in depth. I want to bring Adam back onto the live stream if I can to talk a little bit more about the future of crypto. This crypto winter, while it's been bad for my wallet, I don't think it's a terrible thing for crypto currencies in general. And I think it's going to clarify a little bit as far as which direction things are going in. I'm staying away from anything out of like the top 10 at this point, largely because I want to see DeFi succeed and I don't want to be distracted by stupid meme tokens and basically just ways to get money out of people. Let me see here. Hey Jason, let's use the beer index for inflation measure. How much has a standard beer gone up in the last 6 months in the US? Well, what is a standard beer? And I'm not sure how to answer that question. I'm not trying to be a jerk. A very good friend of mine is actually a brewer. He owns a brewery. I own a bar. I just don't drink standard beer anymore. I guess a standard beer here would be like a Budweiser or a Coors Light or a PBR. I don't touch that stuff anymore. And I don't care if that makes me sound snobby. I live in one of the places in the United States where we have this giant variety of really, really good beers. And I'm really excited about that. Because when I first moved back to the US when I was a kid in my early 20s, there wasn't any good beer here. It was terrible. Like it was a wasteland. And like in the entire state of Texas, which is like twice the size of France, there may have been 2 decent beers in the entire state. One of them was the Celis Brewery, which is actually Pierre Celis from Belgium, and the other one was the Shiner Brewery. And at that time period, that was the only 3. Back then, there was the Pecan Street Brewery, but they've kind of fallen off the map. But now you can go to any town in America, and you can have great beer. Like when I was in Athens, Alabama, last year, I had great local beers when I was there. Everywhere I travel, there's great local beer now. So I rarely drink what's called a standard beer. It's always going to be something that's locally brewed. In case you haven't figured out, I can talk about beer for a long time. It's always going to be something that's locally brewed, and I'm there to taste it, and I'm willing to pay top dollar for it. Top dollar has changed though. Like some of these like fancy like microbrews I'm drinking right now are getting close to $13 or $14 at a liquor store for a 6-pack. So I would say things are up quite a bit. And I would say maybe in the last 2 years, because we had a little bit of a spike in alcohol prices already during the pandemic. I would say that since the pandemic, beer prices are probably up 30%. So beer, a standard 6-pack for a nice locally made IPA here went from about $10.99 to roughly $13.99, $12.99, $13.99. So back in the day, enjoyed a Sam Adams in Vega. It was okay drop. Okay, there's nothing wrong with Sam Adams. It's a great example of one of the first like half decent American beers, but it has been surpassed by thousands of local breweries at this point. The last 30 years have seen an explosion in variety and quality here in the US. So San Diego is probably not the place you want to come for the greatest variety since there's so many IPAs produced here. And we don't have like a very good lager culture because we have Mexico right across the border. They make the Mexican lagers and they're great. But yeah, so this is really, maybe not has the best variety, but has a lot of varieties of different types of IPAs like sessions, hazies, and all that stuff. But yeah, there are other places to go. Brent believes the US dollar will rally as it's the best of the worst currencies and will attract. Yeah, no, that's true. That's actually something we discussed we touched on very briefly in the last live stream that I did. That one of the reasons why the European Central Bank is raising interest rates, even though Europe's economy is in a lot more trouble than ours is because we're already, because of increased yields here in the US and perceived safety. It doesn't matter if we pay you back in inflated dollars after 30 years, we will pay back our obligations, and we've never failed to do so. But now that interest rates are high, yields are rising here in the U.S., we're attracting massive investment from overseas right now into government securities. And when people talk about debt, man, not you guys are pretty smart. But when general people talk about debt, U.S. debt, they're like, "Oh, China owns our debt, or these people own our debt." And look, $9 trillion of our debt, it's all bought on the public market. Anybody can buy it. $9 trillion of it is owned by foreign entities. I think that China owns about 1.4 trillion of that or something. Russia owns about $1 trillion. They could dump it all on the market right now, and that's 2/30 or 1/15 of what's out there. It would increase yields here in the U.S., but it honestly wouldn't increase it by that much. We just Yeah, it wouldn't increase it by that much, especially when the Fed is letting about $120 billion a month roll off the balance sheet at this point. If Russia were to dump all of their debt on the market would essentially normalize by the end of the year. So because of how much the U.S. is taking out of the economy at this point, and I think China realizes too the dollar's been really effectively weaponized, but also aided by the fact that our response to this inflation crisis has actually caused a strengthening of the US dollar and a lot of investment to come over here. So, yeah, we are attracting a lot of the world's liquidity. The best of the worst currencies is kind of there is no best and there is no worst. You know what I mean? It's currencies all float against each other. We live in a pretty dominant society, but if you lived in Europe, in your mind everything would be arranged around euros. If you lived near Europe, everything in your mind would be arranged around euros. Latin America, in their minds, it's arranged around their local currency and dollars. But there is no best of the worst, or best or worst currency in my opinion. So and like I said, I have had to deal with currency issues going back and forth from different countries my entire life, and I came to the understanding years ago that a lot of people that don't travel outside of the United States really do not understand the idea of a floating currency. Like I almost got to an argument with someone before I realized it wasn't used getting into an argument. This is back when they said, oh, when you change your dollars into euros, you lose a third of your money. I was like, what? It's like that's not how currency exchange works, buddy. Yeah, that's just not how it works. I'm not saying you believe that, but I'm saying the general public really doesn't believe that or doesn't understand that. I believe that as well. But yeah, no. What Brent believes is that the currency is rallying largely because we're attracting most of the world's liquidity. We attract most of the world's liquidity not because we have the highest interest rates, is because we're one of the few countries that has never failed to pay back on their obligations. Yeah. So anyway, we are coming up on close to an hour. If you guys don't have any other questions, I am going to end it for the live streams this week. I'm going to be coming out with more of the educational stuff with how to value a stock. I'm probably going to do all of the valuation methods for existing companies first, and like profitable companies first, before I move on to doing valuation methods for companies that have yet to achieve profit, largely because those are actually more involved and those are actually on far less solid footing. Meaning that when a company that hasn't gone public yet says, hey, we're worth $8 billion, to me, that valuation, I don't even like it when people ask me about those valuations, because to me, that's a foundation built on sand. It's only built on forward-looking statements at this point. They have no past to really look at, or at least not a very long one. So yeah, but I'm going to get to those as well. What I'm trying to do is sort of create an entire library of free videos for everyone to have all of the technical knowledge they know to really understand how to invest. Over the last 2 years, almost 3 years of doing this channel now, what I realize is a lot of people are really, really enthusiastic about investing, but they never get, and they know a lot about the companies they invest in, but they never really know anything about how to actually value a company. There are a few exceptions for people who regularly comment on my channel, but there are people that even use some of the financial ratios that I use who don't go far enough when it comes to using those. I don't really understand those. So we'll talk about a couple of different valuation methods, and I'll punch holes in why you should never trust any valuation method. Currently, like I have a price target for Tesla at this point, where I think it's fairly valued based on its future cash flows, but that's fairly valued based on future cash flows, excluding certain lines of business that other people are counting on. I have a price target for that at this point, and it's roughly $500. I think it's like $509 or something. That's my price target for that. But I've blown through every other price target that I've set for Tesla at some point. I'm hoping that we do that again. And I'm going to have to readjust if certain lines of business become more profitable. But all of that is based on projections that may not happen, guys. And that's why it's far easier to put a value on a company that currently has profits, that has a price earnings growth ratio that is easily understood and confirmable, that sort of thing. But yeah, I'm going to go through a bunch of those educational videos for you guys. So yeah, thank you so much, George. And I'm going to be doing, probably trying to do one a week of those for the next year or so. That also seems to be the best way to build my channel. Like I said at the beginning, a lot of the best videos that I had out there in terms of views, they're no longer getting any views at all because that topic is no longer hot. Whereas some of the really boring stuff I did gets 50 to 100 views a day. I need to do more of that material. And yeah, that's where I would think about it. But the reality is I really haven't sold any Tesla, even though I've blown through several of my initial price targets. This time is a little different though, and let's talk about why. I think that by the end of 2023, Tesla will have the ability to produce about 2.7 million vehicles per year. And that is just under half of the production capacity of GM, about half of the production capacity of Ford. At that point, Tesla is if Tesla is basically, you can't say the big three anymore. You'll have to say the big four, right? You can't really say the big four anymore since it's the Daimler Chrysler kind of doesn't really exist. So it's really the big two, which is GM and Ford right now, and Tesla will be the new member of the big three at that point. And I think that's going to happen by the end of 2023, beginning of 2024. At that point, I think that growth starts to look a little bit more reasonable. And yeah, I think it starts a little bit more reasonable. And I think that in terms of vehicle sales, because of far increasing competition, I think that the top end of sales that Tesla ends up doing on an annualized basis when it comes to vehicles is probably going to be around 7.7 to 8 million vehicles per year, very maximum, and that would be a rather optimistic estimation. So, reasonably speaking, I think they do 5.8 to 6 million vehicles year annually at their top, which means that further growth in there is going to have to come from software sales. It's going to have to come from services sales, solar, energy storage, whatever else is out there. But that's kind of what happens. So $509, I think they hit that by late 2023, early 2024, when they hit that about $2.7 million production capacity out there. At that point, they're just one of the big three, right? The United States will be back to having a big three, and they are one of them. Which I'm enormously excited, but in a way kind of sad, because I've been a shareholder of Tesla since 2011. And at that point, I would have ridden them all the way up from an idea that I thought was going to fail at any second to now they're too big to fail, right? And they may already be too big to fail for a lot of different reasons. They may already be too big to fail. You think Tesla is overpriced? Tesla is always overpriced. It's always overpriced. But remember, the price to earnings ratio is basically what the market is willing to pay for a dollar's worth of earnings. And it's even, it's not this way anymore. But at one point, when I was looking at buying more shares, the price to sales ratio was like 1,400 or something ridiculous like that. But all of that is about to get turned on its head, largely because their production capacity is set to explode here in the next year or so. And the year after that, I mean, I think by the end of 2024, they literally have, by the end of 2023, they have roughly 2.7 million. By the end of 2024, they're well over 3 million, maybe close to 4.5 or 3.5 million in production capacity. And at that point, I think they're unstoppable. They'll have continuous factories under production. Interesting thing though, looks like Tesla may be moving. Where is this? Tesla may be moving plans for their battery factory from Germany to the United States, so they can qualify for the subsidy here. Really wanted to talk a little bit about EV news today. We didn't really have a chance to do that, so we're going to do that in the next line. Yeah, and I really want to talk about this. So I read the paper for this. So Adden Energy right here. This is not going to be public anytime soon. But I read the paper online. I have some conclusions from it. I don't know if those are true yet, but if I'm looking at this, it looks like, according to Adden Energy, the self-developed lithium metal battery achieves a charging time of only 3 minutes in the laboratory and a service life of more than 10,000 cycles. The prototype has, anyway, I read the paper that backs this. I want to get an actual expert opinion. I'm not an expert, but I do read a lot of these papers on battery chemistry and battery technology. This sounds enormously promising. It was actually published in Nature as well, which, you don't know, Science, the periodical journal, Science, the periodical journal, Nature are pretty much the most prestigious journals on the planet. If you get published in one of those two, you pretty much made it at this point. If you've never been published in that, well, bless your heart. But anyway, I want to get more confirmation of this, but keep this company in mind for a couple of years. This may be really big news, but like a lot of early technologies, it may or may not be true, but just keep an eye on that. Anyway, we're going to talk more about EVs next time. We've come up on an hour. We talked a little bit more about geopolitics and interest rates and the Fed than I anticipated. I do anticipate, though, that the Fed is going to raise interest rates again at the next meeting. I think it's going to be that full 75 basis points. And I think that employment and consumer spending kind of demonstrated that. And I think you can expect further impacts and volatility in the stock market. So yeah, let's plan accordingly. Anyway, thank you very much for tuning in today. I will be back next Monday. Have a safe weekend. I'll talk to you guys later.